Hello and welcome to the latest episode of On the Money, a weekly look how to get the best out of your savings and investments. In this episode, the focus is on investing in China, including what the threat of tariffs from Donald Trump's return to the White House means for Chinese companies and, by extension, China's stock market. Joining me is Dale Nicholls, Fund Manager of Fidelity China Special Situations and Investment Trust. So to kick off, I have to start with a topic that's front of mind at the moment for investors that have got exposure to China or that perhaps thinking about increasing their exposure to China, particularly given that we're approaching ISA season here in the UK. And that is the threat of the proposed tariffs from Donald Trump's return to the White House. Could you talk us through how much of a risk those proposed tariffs are for Chinese companies and then by extension, China's stock market as a whole?
Yeah, sure. Well, first of all, from an investment perspective, I guess the positive is this has been talked about since you started running. We've been hearing about 60% tariffs. So I think it's very much front of mind for anyone looking at China. I think it's worth stepping back and thinking about sort of actual exposure for companies. If you look at MSCI China in terms of sort of ultimate revenue exposure for companies, the US is probably less than 3%. So it's not a huge exposure, but it's very much, front of mind for a lot of investors. I think it's fair to say it's also front of mind for companies as well. Obviously, China has been dealing with tariffs since the first Trump administration. So there's a lot of companies that are paying 25% already. And it's interesting that if you look at sort of the competitiveness of companies and how it's increased, a lot of companies actually accelerated their share gains during that period. So I think many companies are very well prepared for it. A lot of shifted production offshore. So I think, generally companies are pretty well prepared for what's coming. Yeah, I think the bigger backdrop. And obviously, we'll see how things play out. But I think general direction is it looks like it's probably not going to be that 60% level that's talked about. And China, as well won't be the only target of tariffs this time as well. So I think in general, it's fair to say it's pretty well priced into a lot of companies.
Have you made any changes to the investment trust ahead of these proposed tariffs being put into place?
Yeah, it's interesting. I guess, given the fears that we've talked about, it's actually created quite a bit of opportunity. I think a lot of companies have been sold off on that. So, I'm still very much domestic focused in terms of sort of overall revenues for the trust, but this has created opportunities for more companies offshore. So I would have actually increased my exposure, I think, to companies that have higher tariffs ahead of them, just given where valuations have got to.
Other risks associated with China include concerns over its property market and political risk, given that it was a couple of years ago now, but the government did step in to certain sectors which impacted certain technology businesses and education companies.
Yeah.
Could you talk us through both of those concerns?
Yeah, I think the property risk is very real. Obviously, it's something we've been dealing with for some time, and we've seen a pretty significant correction, particularly in first-tier cities around the property market. Again, I think this is sort of it's pretty well understood, and most importantly, the government's taking real action now. Obviously, the policies that were announced last year. There's a clear, I think, focus from the very top on addressing this issue, and it's an important part of the story. I think in China, it is one of the risks. Obviously, it's been a pretty big jag on the economy in terms of that investment, but it's also still a significant part of the consumer balance sheet, and I think that wealth effect has probably been a factor that's hurt consumer confidence. So it's good to see sort of more action taking place to address that. And obviously recent data points are positive in terms of seeing that stabilization come through. On the regulatory front, I think this is much less of an issue. And I think this is actually more of a tailwind going forward. If you look at, the sort of rhetoric that's coming out of government, it's definitely much more focused on growth. And obviously, given the economic backdrop that we have, that's not a surprise. So in terms of domestic regulation, this is not a great concern. I think it's actually more of a tailwind. And as I said, the focus is much more on growth now. And this is not a surprise. If you look at sort of really the long term around regulation, obviously we had quite a tough period in the last few years around regulation, and has been a headwind. But there is a cyclicality to it. And in periods now where growth has been weak, I think it's much more of a tailwind in terms of, sort of potentially relaxing regulation. And if you think about areas like education, and I think probably the poster child of the regulatory impact is someone like New Oriental Education. I mean, they're on track to hit a new earnings high. So I think that's sort of an example of there being, I guess, more support for companies out there in this period of relatively weak growth.
So I've asked you a couple of questions related to risk. So let's now move on to opportunities. So let's start off with the government's recent fiscal stimulus. It was warmly received by stock markets. China's stock market soared in September. Could you talk us through why the stimulus was introduced and what it was seeking to achieve?
Yeah, I think what's behind it is a much greater recognition from the very top about the economic weakness and particularly the risks around areas like deflation and the property market. So that level of, I think, commitment to doing something about that, I think, is really positive. The initial announcements have been mostly on the monetary side. So there's pretty high expectations around the fiscal side. And I think that perhaps with some investors, the sort of expectation of a big bazooka type stimulus that we'd seen in the past, maybe those sort of expectations are too high, and sort of expectations about really significant numbers coming out on the fiscal side, sort of expectations have been too high. What's positive for me is that commitment. And I think you'll see increasing measures over time, particularly on the fiscal side, to address the weakness and particularly support the consumer. And I think that'll be different. That is what will be different to sort of past cycles of stimulus. What's positive for me is, again, that commitment from the top. And I think you'll see, increased measures to support the overall economy and particular consumption.
As mentioned, stock markets rallied on the back of that stimulus announcement. However, the rally only lasted a couple of weeks. Could you explain why it only lasted a couple of weeks, why it wasn't sustained? And in 2025, do you think there may be further stimulus announcements?
Yeah, I think definitely. And I think probably, again, it sort of comes back to that disappointment around the lack of big numbers on the fiscal side is probably, again, where the disappointment has come from. But again, stepping back, I think, there's going to be increased measures. And again, particularly, sort of more measures to address the weakness in the property market and particularly pricing, which I think is positive. And like I said, there's sort of some initial positive signs around price stabilization. I know it's only a couple of months of sort of increases that we've seen in first tier cities, but there's definite signs of stabilization and some green shoots for the sort of the economy more in general that we see on the ground meeting with companies.
In terms of valuations, it's well known that China is carrying a lower valuation compared to its history, and it's a lot lower than other regions, particularly the US. Now, I know you have a preference for domestically focused companies. Could you drill down and explain which sectors and types of businesses you're favouring at the moment that are carrying low valuations? Yeah,
no, you're exactly right. The valuations versus history are probably about a standard deviation off historical levels. If you sort of look at those valuations versus the US, we're probably at maybe a 60%, if not higher, sort of discount, versus the US. So the fear that we've talked about in the market definitely has impacted valuations. In terms of where the value is, I actually think it's pretty broad-based. You can find it across a range of sectors. You could look at the big tech sector, particularly the companies that would have exposure to areas like cross-border e-commerce, and again, that sort of geopolitical concern, and how that's sort of flowing into valuation. But like I said, it's pretty broad-based. The area that in the trust that I would have increased the most in the past 12 months is actually in consumer, and that's across discretionary, across staples. For me, that's where I found significant value really over the past 12 months. And it's comes back to that concern about sort of general consumer confidence. But if you look at the consumer balance sheet, because they have been underspending, you've got significant build-up of deposits on the consumer balance sheets. The balance sheet is actually quite strong. Debt levels have also come down. So the spending power is there. We just need better confidence. And I guess sort of what we're seeing in terms of property, hopefully some incrementally better expectations around employment, that type of thing can lead to sort of better consumer confidence. Elsewhere, industrials is a big bet for me. Again, sort of the cyclical slowdown, those types of concerns we talked about earlier, the ones that do have export exposure and the sort of tariff risk, that fear has fed into valuations there as well. So that's created opportunity. But like I said, it's really across a range of sectors, even in healthcare. That's been a pretty big underperformer. There's opportunity there, and also in the financials, just given sort of the weakness that we've seen in the economy. For me, not so much the banks, but areas like insurance, consumer finance, that sort of thing, where, just sort of general concerns around credit and the consumer in general has created quite a bit of opportunity there as well.
Could you name perhaps a couple of examples of consumer-related stocks that you own to give our listeners a flavour of the types of companies that you like?
Yeah, absolutely. If you look at an area like sportswear, you've got a company like Anta, which just has a fantastic record of execution over time, taking share from, perhaps the bigger international brands, executing well across the portfolio, smaller brands like Fila and that sort of thing. If you look at like Fila, the performance that they've achieved in China versus the Fila brand more globally, it sort of shows their ability to execute. And spending on sportswear in China, although it's been relatively resilient over the years relative to other sectors, still quite low relative to sort of levels that you see in the West. If you look at areas like staples, areas like beer, condiments, dairy, these types of areas where you just see pretty strong brands that are trading at really significant discounts to sort of staples valuations that you see elsewhere in the world.
And you mentioned industrials. Could you pick out a couple of companies in that sector or types of businesses within industrials? It's obviously a very broad sector.
Yeah. I think, the sort of increased competitiveness of a lot of industrials is really underappreciated in the market. If you think about an area like the electric vehicle space, look at the competitiveness of companies in that area. So I think there's sort of an underappreciation of just the sheer volume in these areas. So, China is now producing over 60% of the world's EVs. If you look at their market share of the whole supply chain, it's even higher. And you've seen them go from, I guess number 5 or so to number 1 in auto exports over the last 5 years. So don't get me wrong, the auto sector has its challenges with supply, but across a range of areas, we're seeing just really a big increase in competitiveness. Again, on the back of them leveraging a huge domestic market and driving those volumes and how that's flowed into costs. But also it's on the back of pretty significant increase in R&D spend over the years, and that's sort of throwing through into increased competitiveness as well. You've seen Chinese companies, over the last decade or so grow their R&D spend at around a 20% CAGR. So they've been spending, and you're seeing that come through in increased competitiveness. And again, because of the fears that we talked about, globally around things like tariffs, in many cases, I think that has sort of been underappreciated in markets.
The investment trust has some exposure to unlisted companies. Could you explain in percentage terms how much you have at the moment? And could you talk us through the process in terms of how often these companies are reevaluated?
Right. So we're at just over 10% now. We have a pretty rigorous fair value process. So obviously if there's significant earnings events or liquidity events and that sort of thing, we sort of rapidly update those prices. But then on a monthly basis, there's quite a significant amount of work that happens between the analysts we have and our fair value team around those valuations. And then on top of that, there's a third party that we'll use to sort of, again, just test those valuations. And sort of as a result of that debate, there's a pretty consistent updating of fair values. So I think it's a pretty rigorous process. And I feel pretty comfortable with the way we're valuing, a lot of companies in the portfolio, and actually pretty excited about some of the potential value coming out of that part of the portfolio.
And finally, could I ask you to name what you think is the biggest opportunity at the moment for investing in China? And could you also explain what you think is the biggest risk, if you had to pick out the biggest risk?
If we're talking about opportunity, I think we've touched on, a lot of the potential ingredients for the value to be realized. We know there's significant value. We just need, a slowly improving environment. I don't think we need a huge recovery in the economy. I think, particularly around, stabilization of things like property, and, that flowing into earnings, I think, is probably going to be the catalyst. It's a great stock picking market on the ground. There's a lot of consolidation across sectors. So that's, again, for a bottom-up stock picker, creating a lot of opportunity at the stock level. So, in a market where it's often impacted by the overall sort of macro headlines or geopolitical headlines, we're seeing companies that are executing quite well. So that's, kind of the opportunity. I think, probably another area that's underappreciated is just what's happening in terms of capital return. So if you look at, the growth in the level of buybacks and dividends and that sort of thing. It's really significant in terms of the improvement that we've seen over the past few years, and compares well to markets where that's much, more greatly appreciated in markets like Japan. So, I think they're sort of the areas of opportunity. In terms of risks, I'd have to focus on the macro, and if we didn't see things stabilize in the property sector, you'd have to highlight that as one of the risks. You would have to point to, the sort of geopolitical side as well. But again, my sense is a lot of that is sort of well priced in the markets at these levels.
My thanks to Dale, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and do tell a friend about it. And if you get a chance, leave us a review or a rating in your podcast app too. You can join the conversation, ask questions and tell us what you'd like us to talk about via email on otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website, ii.co.uk. And I'll see you next week.